Hello everyone, welcome back to the channel. In our last video, we discussed about bull call spread and bear put spread, where we have very clear direction of the market. When we are bullish about the market, then we can take bull call spread. When we are bearish, then we can go for the bear put spread. But what if we are not sure about the market condition and we don't know how the market will move for this month? So, and we feel that market may not make any move. In that cases, we can use this delta neutral strategies. So today is we will discuss about one of these delta neutral strategy. So one of the majorly used delta neutral strategy is short strangle. So we can deploy the short strangle whenever we feel that market may not make bigger moves and and a wide range we can get with this short strangle. So even if market makes a move of 3% in either direction, we can still be in the profit view. So let's quickly see how we can uh, deploy this short triangle and what are the advantages we get and what are the disadvantages. So as again I'm repeating, like when we feel that market was neutral and it may not make a much bigger moves on either side. So in this short triangle, this is a two-leg strategy. So we will be selling this dip on these two legs. Which strikes to select is completely depends upon the how much risk we are ready to take. So a person who can adjust their positions, uh, an expert trader can adjust their positions when market goes against them. Uh, that means they are very risk-prone traders can take much closer to the Ardhaman. But the newly traders and new beginners in the trading, I will suggest them go much further away from the Ardhamani and select your strikes. So in this video, let us take 3% away from the Ardhamani strike. So currently the market, I'm taking August 30th as an example. For the September expiry, let's take September expiry here. So, okay, the at the money here is 25,250. So the first leg is we will deploy the CE side. So on the call side, let's go around 750 points, consists around 300 point, no, sorry, 3%. So it goes to 26,000. Calculate the 5,250 plus 3%. So around 26,000. So let's go to 26,000. So we have 26,000 trading at 77 premium. Let's sell one lot here. And then similarly, we'll go down 750 points from the other money, and then we will sell that put option. So this is 24,550. So okay, now you will see we are at the center of this profit zone, and we can see the market can make move 750 points upside and then the downside. We still be in the profit zone. Let's quickly see, and these are neutral strategies. And one more thing we can observe here is like you can look at the Greeks of these two legs which we sold. So the delta is, if you see the delta section, and if somebody who are not familiar with these Greeks, I will plan to make a video about each, how these Greeks will affect our profit and how the volatility in the market gets affect these Greeks will affect our premium values of these legs, which needs to be known for every option seller actually. It's it plays a bigger role. So for now, let's understand about this delta. So here we'll see the delta for both the call side and then the put side are very much closer, and if you add both of them, then it will become like a near to the zero value. So that's why we also call these strategies, these neutral strategies, as delta neutral strategy. So the pro traders try to make this delta as always neutral so that they will always be in that profit zone. But for now, like we'll make a basic short strangle and how we can make profit out of this one. So so the first rule is you should have conviction about the market that market will not make a big moves. And if you think market may move 5% upside and downside, then you can go further away from the other money and take those options option trades on the both sides. But always remember, try to make both the sides at equal distance. Only in that case it will become a delta neutral strategy. Or another way of deploying the strategy, you can look at the delta values and you can go further away and having the same delta you can capture. For now, I'm much comfortable with this number of percentage moving away from the market, from the other money. Okay, now just let's understand some of these things. So the estimated margin, since you're having selling on the both sides, so the margin will be required around 68,000. The probability of the profits is 71%. I think it is if you maintain this strategy properly, then you will get more than this one. And this is a since we are selling on the both sides, so this is you will get credit, and whatever you get the credit that will become your maximum profit. And the break evens, if you see on the both side, we have around 3.6 percentage. So on the both side, if market makes a 3.6 percentage, you will be in the profit. So it consists around 7 percentage. In that range, if market is making moves, then we don't have any issues. Now, yeah. So now let's see how it works when we move ahead. So let me go to the next day. So let me make next day at every day around 3:15. Let's watch it around that. So we will not do any adjustments until unless where the spot of the market moves away from our break evens. We will not do any adjustments. So we can see okay, we have after 2 days we have a profit of 212 rupees. So this is a monthly strategy. So you can apply this in the weekly strategies as well in the Nifty. But always as a beginner, I don't prefer the people to do the strategy on the weekly where we have very much less time to adjust the strategy if market makes a bigger move. So it's always be advisable to do it on the monthly ones. Okay. So if see on one side market was uh, falling, so you can see the put premiums were went down. So I'm not doing any adjustments. I will stick to a basic plan like don't doing any adjustment till we reach the break evens. But if people are comfortable in closing this strategy, like on the C side, you can close and have and take a similar op CE strike where the Greeks, you can always look at this Greek value. So you can look for 0.33 Greek value of a CE side and you can sell it. But I think it is still in under control, the strategy, so we can continue. There it is. We are into the profit zone again. Let's move ahead. Yeah, now the both the legs are giving you the profit. So this is the reason why I don't want to give the adjustments at the early stage because if market make the move from the other directions. So what I'm saying last time when we see that CE value went for 15, 17, the market was staying around here. Then the market rised after a couple of days. So in that case, like if we have closed the CE position and added another CE value much closer to the Nifty, we will be in a loss. So the better is always stay away from adjustments in the early stages and look at for our break even. If market is moving away and the strategy is going out of our control, then we can start making the adjustment. So far everything is good. Let's go ahead. and you can look like our uh, total profit is around 70 percentage to our max profit. So this is another way of exit from this strategy. So you can keep some deadlines like 70 percentage of the profit. If I get of the maximum profit, you can exit the strategy. And for the next month expiry, currently we are taking for October expiry. So for November expiry, you can take trades from the next day or from on the day. So this is one of the best way of exiting from the strategy, from the profitable strategy. So the reason why when we started this strategy, we are neutral about the market, but it it may not be the same after 10 days or 2 weeks. The market may have some news or some other reasons the market making a big move. So when you get the 70 percentage or 75 percentage of your profit, book the profit and do the same thing for the next month expiry. The reason why I want you to book the profit and next month expiry is again the same reason. In for the next month expiry, you this is September expiry. For October expiry, you will get a lot of time. If even if market makes a bigger move, you can adjust your positions easily. So it is easy for adjustments when the expiry is far away from our date. So currently we are at September 16th. The expiry is just 1.5 week away. So if market makes a bigger moves, it will be difficult for the adjustment because the premiums will be less to adjust. Okay, we'll still go and see till we reach the 75 or 80 percentage of the profit. Okay, so for good. Okay, market is in our green zone. Yeah, so if you see, we almost reach 80 percentage of our profit. So I feel this is the right time to exit from this strategy. The other reason also is like, even if you get 40 percentage or 50 percentage here, I would say to exit because we are left only with 1 week for the expiry. So if we go ahead for the next week, if market makes a bigger move, we will be left with few days, and the premiums are also very low to adjust the positions. So you can see the premiums also they came to 12 and 14. Uh, and if you want to adjust also, so the premiums only at the money premiums will be high and everything will be very low. So it will become very hard to adjust the position. So this is the right time to exit from this strategy. If you want, you can book the if you are trading with multiple lots, you can book partial profits. For now, for example, for this explaining, I've taken only one lot as an example. But if you are trading with multiple lots, then you can book 50 percentage of your lots, book the profit, and the 50 percentage you can take further. And similarly, on the downside, like if market in initial level itself, market makes a bigger moves, how to adjust the positions and how we can manage that position, we will discuss in detail in our adjustment video. If you like this content, please like this video, and for our earlier videos, please do check out in the description of this video. We have multiple strategies been explaining, so please do check out in the description and share it with your friends, and please subscribe to the channel. Thank you.